the one thing keeping you broke on gold. What if every time you got stopped out on gold, the move went exactly your way 10 minutes later? You were not wrong about the direction. You were wrong about the entry. And that single mistake is costing traders hundreds, sometimes thousands of pounds a week. I am going to show you the only supply and demand framework you will ever need to trade Xauusd. No indicators cluttering your screen, no guessing. Just a raw logic that the smart money uses to move gold, and how you can position yourself right alongside them. What you will be able to do after this video. Here is the roadmap for today. By the end of this breakdown, you will be able to do 3 things. First, you will know exactly how to spot a high probability supply or demand zone on gold, not a line, a zone before price even arrives. Second, you will have a 2-step confluence checklist that keeps you out of the bad setups and gets you into the clean ones. Third, I will walk you through a live example in each of the 4 market conditions, ranging uptrend, downtrend, and reversal, so you can use this no matter what gold is doing. Stick around, because later I will show you the exact entry trigger that separates a professional sniper entry from a reckless punt. Do not skip that part. Section 1. Why supply and demand, not support and resistance. Most traders draw a horizontal line and call it support or resistance. The market does not respect a line. It respects a zone, a price area, where institutional orders are queued and waiting. Think of it this way. A big bank wants to sell 50,000 ounces of gold. They cannot dump that in one click, it would move the market against them. So they sell in layers, across a price band. That band is your supply zone. When price returns to that band, the remaining orders fire, and you get another leg down. This is why supply and demand zones have predictive power that a single line never will. You're not drawing a line where price bounced before. You are marking where institutional order flow is still sitting, unexecuted, waiting for price to return. From this point on, think in zones, not lines. A zone has a top edge and a bottom edge, typically formed by the body of the candle that started the aggressive move. Section 2. How to draw a supply or demand zone in 30 seconds. Drawing a zone is simple once you know what you are looking for. Here is the exact process. For a supply zone, scan the chart for an area where multiple red candles printed in a row 3 or more with large bodies and very little wicking. That cluster of aggressive selling tells you there is institutional supply at that price band. Draw a rectangle from the top of the last candle body before the drop to the bottom of the same candle. That is your zone. For a demand zone, flip it. Find where multiple large green candles printed consecutively. Draw your box from the bottom of the last candle body before the impulse to the top of that candle. The most powerful zones are the ones where price left quickly and violently. A slow grind up to a level is noise. A sharp, explosive move away from a level that is institutional fingerprints. Those are the zones worth trading. One more rule. The more times price revisits a zone without breaking through it, the weaker it becomes. Fresh zones once price has not yet returned to carry the highest probability. Always prefer the fresh zone over the tested one. Section 3. The 2 confluence entry checklist. Never skip this. Here is where most traders fail. They see price touch a supply or demand zone, and they fire a trade immediately. Sometimes it works. Most of the time, price just keeps running through the zone, and they take a full stop loss. The fix is a 2-part confluence checklist. Both boxes must tick before you enter. Not one, both. Confluence number 1. The 8-period exponential moving average crossover. On the 1 5-minute chart, I want to see the candles cross and close on the other side of the 8 EMA. For a supply zone sell, I need to see candles start closing below the EMA, not just wicking below it, closing below it. For a demand zone buy, candles crossing and closing above the EMA. The crossover tells you the short-term momentum has shifted against a prevailing move. That is your first green light. Confluence number 2, a confirmation candle. I want to see at least one large candle, a bearish engulfing, a pin bar rejection, or a strong bodied candle in the direction of the trade, forming while price is inside the zone. This candle tells you the institutions are actively defending that zone right now, not yesterday, right now. When you have both EMA crossover plus confirmation candle, that is when you execute, not before. This discipline alone will cut your losing trades by more than half. Section 4. Trading gold in a ranging market. Most people get this wrong. The ranging market is actually where supply and demand shines most. Most traders see a sideways chart and walk away because they were taught you cannot trade ranges. That is backwards. A range gives you two defined zones, supply at the top, demand at the bottom, and price will oscillate between them until one side breaks. That means you get multiple high probability setups per range, not zero. Here is a real example on Xauusd at the H1 timeframe. Price is oscillating between roughly 2,310 and 2,355. At the top of the range, we have a supply zone. Multiple large red candles formed there. Price dropped sharply on each test. At the bottom, we have a demand zone. Multiple large green candles, price bounced hard each time. The setup. Price rallies back up into the supply zone around 2,346 to 2,354. I move down to the 1-5-minute chart and wait. Within a few candles, I see the 8 EMA cross. The candles start closing below the EMA for the first time since price entered the zone. And then, I get a large bearish engulfing candle. Clean, no wick confusion. That is my entry. Sell at the close of that candle. Stop loss above the supply zone top, around 2,358. Take profit at the demand zone below, around 2,315. That is a risk to reward of approximately 1 to 3, 5 on a ranging market trade. No trend needed. Section 5. Trading gold in an uptrend. Ride the pullback like a pro. When gold is in a confirmed uptrend, higher highs, higher lows on the H1, you are looking for demand zones to enter long on the pullbacks. You are buying the dip into institutional demand, not chasing the top. Here is how to identify the uptrend's demand zones. After a strong bullish impulse, multiple large green candles printing in a row mark the base of that impulse. That base is where the institutional buy orders originally fired. When price pulls back to retest that base, there are unfilled buy orders waiting there, and the institutions will add more. Recent Xauusd action gives us a clean example. After gold broke above 2,330 inches early June 2025, it impulsed up to around 2,360 on multiple large green H1 candles. The demand zone sits between approximately 2,328 and 2,336, the base of that push. Price pulled back into that zone over the following 2 sessions. On the 1-5-minute chart, I waited. The 8 EMA had been above price bearish short-term momentum. Then, a large bullish engulfing formed right inside the zone, and the candles crossed above the EMA. That is the entry. Buy at close. Stop below the zone around 2,321. Take profit at the prior high around 2,362. A clean 1 to 4, 5 risk to reward trade, and price ran straight to the target within 36 hours. The key discipline here is patience. Chasing the impulse candle is the amateur move. The professional waits for the pullback to the zone, gets the 2 confluences, and enters with a sniper's precision. Quick one, if this breakdown is making sense. A like genuinely helps the channel reach more traders who need this. It takes 1 second and it means a lot. Right, back to the setups. Section 6. Trading gold in a downtrend. Short the rip. A downtrend is the mirror of what we just covered. Price is making lower highs and lower lows, and you are looking for supply zones to enter short on the rallies, the dead cat bounces that pull price back up before it continues lower. In a downtrend, every supply zone has already proven itself. The first test created the lower high. A second visit creates another lower high and gives you the entry. The structure is already on your side. Here is the setup. Gold has been in a downtrend on the H1. Price has been making lower highs around the 2,358 to 2,366 region. Each time price gets up there, aggressive selling takes over. That is a well-established supply zone with multiple confirmations, which makes it high probability. Price rallies up into the zone again. On the 1-5-minute time frame, I'm watching the 8 EMA. The candles are above the EMA during the rally upward short-term momentum. Then the momentum shifts. The candles cross below the EMA, and I get a large bearish pin bar rejecting off the top of the zone. That is the entry. Sell at close of the pin bar. Stop goes above the supply zone, above the last lower high, not tight, because price needs room. If you put the stop too tight, a 3 or 4 pip wick will take you out before price collapses in your direction. Give it breathing room. Take profit at the next significant support structure below, around 2,318. The trade played out over roughly 2 days, delivering just over 40 pips and at 0.1 lots on gold, that is around $400 from a single trade. Section 7. Trading a reversal on gold, spotting the shift before it happens. The reversal setup is the one that pays the most, and the one that kills the most accounts when traded wrong. The mistake traders make is this. They see price pull away from a level sharply, and they immediately enter, assuming the reversal is already in motion. It is not. The market must retest the zone to confirm it. Entering before the retest is pure hope, not analysis. Here is how a proper reversal trade looks on gold. Price has been in an uptrend, making higher highs and higher lows. But then, we see a significant red candle push down and take out the previous higher low. That is a warning sign. Market structure may be shifting. We now have a demand zone at that previous higher low area. Price has bounced hard from there before multiple large green candles confirm demand. The question is, will price come back and use that zone as a springboard for another leg up? Or has something fundamentally changed and will it break through? We do not predict, we react. Price comes back down to the zone. On the 1-5-minute chart, I wait for my 2 confluences EMA crossover to the upside and a large bullish confirmation candle. When both appear, I enter long. Stop below the zone base. Take profit at the previous high or a 1 to 2, 5 risk to reward level. If price breaks through the demand zone instead, no problem. We had our confirmation criteria. We did not enter. We simply reevaluate the next zone lower. This is how professionals stay in the game long term. By refusing to enter without confirmation, and by never marrying a directional bias. Section 8. Where to put your stop loss. Most traders place it too tight. The most common reason a technically correct setup still results in a loss is the stop placement. Traders put the stop 1 or 2 pips above the zone edge. Price wicks just past it, then reverses exactly as expected, and they are already out, watching the move without them. Here is the rule. Your stop loss goes above the zone, plus a buffer. For gold, specifically, which is a volatile instrument, I use a minimum buffer of 8 to 12 pips beyond the zone edge. On higher timeframe setups, that buffer can go up to 15 or 20 pips. The reason? Market makers know where the obvious stops are. They will often push price a few pips past a visible level to collect those stops before reversing. Your buffer is protection against that. For take profit, the rule is simpler. Look left. Find the nearest significant price level where price previously reversed a prior high for sells, a prior low for buys. That is where price is likely to slow or stall. Place or take profit just in front of that level, not at it, because price may not quite reach it before reversing. Never move your stop loss further away once you are in the trade. If your analysis was wrong, accept the small loss and move on. The professionals that last in this game are the ones who accept small losses quickly and let winning trades run. Section 9. The multi-time frame approach. H1 zone, 15M entry. Here is a detail I want to make very clear because it is the source of a lot of confusion for newer traders. When I talk about identifying supply and demand zones, I am doing that on the H1 chart, the 1-hour time frame. But when I am looking for my entry trigger, the EMA crossover and the confirmation candle, I drop down to the 1-5-minute chart. Why does this matter? Because the H1 chart defines the zone, the area of institutional interest. The 1-5-minute chart tells you the precise moment within that zone when the institutional selling or buying is actively resuming. If you try to take your entry on the H1, you will always be late. The candle has already moved too far from the zone edge. Your stop has to be wider, and your risk to reward shrinks. The 1-5-minute entry inside an H1 zone gives you what traders call a sniper entry. You are entering precisely when the move is beginning, with a tight stop that still respects the zone, and a target that gives you a favorable risk to reward. Here is the workflow. Step 1. Mark your zone on H1. Step 2. Set an alert so you are notified when price enters the zone. You do not need to stare at the screen. Step 3. When the alert fires, open the 1-5-minute chart and start monitoring for your two confluences. Step 4. When both confluences confirm, execute the trade. Step 5. Set your stop and take profit orders immediately and walk away. Do not sit and watch the trade that leads to emotional interference and premature exits. This top-down approach, using the higher time frame for context and the lower time frame for execution, is the single biggest upgrade most retail traders can make to their process. It keeps you aligned with the big picture while giving you a precision entry that maximizes your reward for every pound of risk you take. Section 10. Risk Management. Why 1-2% per trade keeps you in the game. No strategy, not this one, not any other, will win every trade. Even the cleanest supply and demand setup will sometimes fail. A news event, a surprise central bank announcement, a geopolitical shock can override any technical framework. This is the reality of trading gold, which is one of the most news-sensitive instruments in the market. This is why risk management is not optional. It is the foundation everything else sits on. The rule is simple and non-negotiable. Risk no more than 1-2% of your trading account on any single trade. If you have a £5,000 account, your maximum risk per trade is £50 to £100. If you lose 10 trades in a row, which is genuinely possible even with a strong strategy, you have lost between 10 and 20% of your account, and you are still very much in the game. Now compare that to a trader who risks 10% per trade. 10 consecutive losers gone, account wiped, and 10 consecutive losers is not even that unusual during a difficult market phase. Here is how to calculate your lot size for each trade. Take your account balance, multiply by your risk percentage to get the pound or dollar amount at risk. Then divide that by the number of pips to your stop loss, adjusted for the lot size value on gold. On Xauusd, one standard lot moves $10 per pip. One mini lot, 0.1, moves $1 per pip. One micro lot, 0.01, moves 10 cents per pip. So if your stop is 30 pips and you are risking £100 at an exchange rate close to 1, you need a position size that loses £100 over 30 pips, that is approximately 0.33 lots on gold. Most platforms will calculate this for you automatically if you input your risk amount and stop level size correctly every single time. Inconsistent sizing is the silent account killer. Traders double their size on a trade they feel confident about. It loses, and suddenly one loss wipes out 6 previous winners. Section 11. The 5 mistakes that make this strategy fail for most traders. I want to address the most common objections and mistakes I see when traders first apply supply and demand to gold, because I guarantee you will encounter every single one of these. Mistake 1. Entering before the two confluences. I have said this multiple times, and I will say it again, because traders still do it. They see price touch the zone, and they feel the urgency to be in the trade. Resist it. The urgency you feel is FOMO, fear of missing out, and it is the most expensive emotion in trading. If you miss a setup, because you waited for confirmation, another one will come. If you blow your account by entering without confirmation, you will not be around to trade the next one. Mistake 2. Trading against the higher timeframe trend. Supply and demand zones work in every market condition, but they work best when they align with a higher timeframe trend direction. If the daily chart on gold is in a strong uptrend, your demand zone buys on the H1 will have much higher probability than your supply zone sells. Counter-trend trades work, but carry higher risk. When you are learning, stick to trend-aligned trades. Mistake 3. Ignoring upcoming high-impact news. Gold is extraordinarily sensitive to U.S. economic data, non-farm payrolls, CPI inflation, Federal Reserve rate decisions, and FOMC minutes. If a major news event is scheduled within 2 hours of your intended entry, wait. The news can create a false break of your zone that stops you out before reversing. Check the economic calendar every session before you plot your setups. Mistake 4. Redrawing zones to suit the trade you want to make. If price breaks through your zone, the zone is invalidated. Do not redraw it lower to justify staying in a trade. Accept the stop loss, move on, and find the next valid zone. Mistake 5. Taking profit too early. Once the trade is running in your direction, the temptation is to close early and lock in a small gain. That might feel safe, but over hundreds of trades, it massively reduces your overall profitability. Trust the analysis, trust the take profit level you identified, and let the trade run. You can always move your stop to break even once price has moved a meaningful distance in your direction, but do not close the trade manually just because of short-term volatility. The 5 things to remember. Let me bring it all together quickly. 1. Trade zones, not lines. A zone has a top and a bottom edge and reflects where institutional orders are clustered. 2. The strongest zones are the fresh ones, areas price left explosively and has not yet returned to. 3. Never enter the moment price touches a zone. Wait for both confluences EMA crossover on the 1 5-minute chart and a confirmation candle. 4. Your stop loss goes beyond the zone with a buffer of at least 8 to 12 pips on gold. Tight stops on gold get hunted. 5. Look left for your take profit. Place it just in front of the nearest prior reversal level, and do not adjust your stop away from you once you are in the trade. This framework works in every market condition, ranging uptrend, downtrend, reversal. That is the beauty of it. You do not need to predict what the market is about to do. You just need to be ready when price visits your zone. If you found this useful, subscribe and turn on the notification bell. The next breakdown drops every week, and I do not want you to miss it. I cover Xauusd, the major Forex pairs, and occasionally crypto when the setups are clean. And if you want to go deeper on supply and demand, including how to spot the institutional order flow signals that most traders completely miss, I have a full guide linked in the description. Check it out. Until next time, be patient, be disciplined, and remember, you are just one quality trade away.